All right. Hey guys, welcome to the channel. My name's Jerome. I'm a realtor here and focused around the Fraser Valley of BC, Canada. Thanks for tuning in. We're here today to discuss mortgages, financing, specifically pre-sale financing, as well as other programs RBC might have. We're joined by my special guests here from RBC, Julie and Shiv. I'll have them introduce themselves and we can get started right away.
Excellent. Thank you, Jerome. Shiv, do you want to introduce yourself first?
Yeah, my name is Shiv Man. I'm a mobile mortgage specialist with RBC and specializing in builder pre-sales.
Excellent. And I am Julie Anningson, sales manager for builder development for RBC on the beautiful BC coast. And we are so grateful to be here today. Thank you so much for joining us. It is definitely a pleasure and interesting venue to present to you all in. But as Jerome mentioned, we are here to chat about a bit about presale financing and advise you of some specialized programs that we have to offer specific to investors, newcomers, and first-time home buyers. So hopefully the information we present you today is valuable. I hope you find value in it. It is a very candid session today, so feel free to enter your comments or questions in the chat. I know Jerome's going to keep his eye on that for us as we go through some material here. But also feel free to take yourself off mute if you do have questions. Certainly open to those throughout the presentation. So yeah, we'll kick it off.
Awesome. Thanks guys for being here, and yeah, get started.
Excellent. So exactly that. What do you need to know about presale financing? So my role as sales manager for builder development, I work with real estate firms, realtors, developers, sales and marketing teams to implement what we call pre-sale financing packages for you as the buyer. That does not preclude any developments from offering pre-sale financing. So just so you know, anytime you're looking at something that hasn't been lived in is essentially considered a pre-sale financing option. So if we'll go to the next screen, Jerome. Really, we're excited for the opportunity to work with you. So really, what RBC offers is an end-to-end support program whereby we initiate our contact with you right from onset. So, and even preferably if you're working with Jerome and you're looking at buying a pre-sale property, we're going to engage with you right from the very beginning in your a search journey. So when you're out there looking at pre-sale properties and you find something that you're interested in, we actually want to get you in front of a financial advisor like Shiv to get your mortgage approved up front. And we're going to work with you throughout that entire journey. So as you know, in a pre-sale world, typically something's not going to be ready to move in right away. So you're looking at financing something that is potentially not going to be built for 12 months, up to 36 months, possibly even longer in some cases. We're looking at 5 years. So when those instances come up and you find something that you really like and you want to buy into, we want to make sure that we approve all those details up front so that you can sit back and watch your home be built. And the wonderful thing is you have no stress. You know you're approved, you've got your rate locked in, and you're ready to go. Shiv and our mortgage specialist team will work with you, like I said, from the very beginning of that process to the very end. So they're going to have regular contact points with you throughout that journey, just to make sure the development is on target to meet its completion dates. And then, of course, at completion, when everything is getting wrapped up and you're ready to move in. So if we'll move to the next slide, Jerome. So what our RBC difference is really around our firm approvals. When we say we firmly approve you, we firmly approve you. So for example, you're working with Jerome today and you're looking at a pre-sale property that's not going to complete for 36 months. Jerome's going to say, okay, you need to talk to Shiv, and Shiv is going to look at all of those income documents, financials, your credit history, the appraisal. We're going to look at all of that information up front today, and then we're going to firmly approve you. So once you're approved, you stay approved. If in the event something changes financially over the course of the construction, so within the 3-year period, let's just say the construction is going to be built in, we're not going to revisit that information. So because we approved you on day one, you're going to stay approved right up until you move into that new home. And that's really a differentiator in the market when it comes to our RBC preferred financing program. So we take a look at all of that information up front and get everything in order, and you just sit back and watch your home be built. Next slide.
Can I do a question real quick?
Yes, yeah.
So is the appraisal done up front as well, or closer
Yes.
towards completion? Oh,
Yes.
okay.
It is done up front. And that's another reason why it's so important, if you're looking at buying pre-sale, to not wait to have that financing discussion. Because as you know, or some of you may not know, but in the market today, we are seeing some homes that are coming in valued less than perhaps what somebody bought it for 9 months ago or a year ago. So it's really important, as soon as you sign that contract, or if you're even entertaining signing a contract, you want to get in front of a SHIV or a mortgage specialist as soon as possible, so that you can have that conversation and understand the risks of waiting. And the appraisal or the valuation is one of those risks, right? Because as we know, things can fluctuate. We can see devaluations on our properties, like some of us are seeing right now. So yes,
Okay.
Ours are done up front.
Mm.
The firm approvals, so we're firm approving you, whether it's 12 months, 36 months, or 60 months, up to 60 months. And that, of course, would depend on the project. Some of our projects, if any of you are located in Surrey, we've got a lot of large towers going up. A number of them are going to take 48 to 60 months to build. We're firmly approving those details up front, and we're locking in a rate. So this is another risk factor that you need to consider when you're buying pre-sale, is that we're locking and loading your rate today. So even though we're hedging what that rate will be in 5 years from now, we're going to quote you a rate that you won't pay more. So for an example, let's just say somebody bought a property last year, and it was going to be, say, a 12-month build. So it was essentially completing this fall. So they purchased it last year, and our rates last year, of anybody who knows, were probably in around about 349, I'm going to say 369 for a 12-month rate cap. So we're looking at pricing something that's not built yet. So it's not today's rate, it's the rate that's going to happen in 12 months from now. If that individual came to RBC back in October of 2021, let's just say I bought a property, now I'd like to get my firm approval, my rate locked in, we would have locked them in at 369, okay? That's just an example. I'm throwing a number out there. Let's just say that another client, same scenario, waited. So they purchased a property, they wrote the contract, they put their deposits in, and now they're looking at financing that property because they didn't do it up front. Now we're looking at gathering all that income documentation, all of the credit bureau is going to have to be done, the appraisal is going to have to be done, and we're going to be looking at locking in rates as of today. So anybody who's been watching the market will know that rates today are probably looking at more like 5.5, 569, 579. Now they're looking at a 2% increase in their interest rate over the course of however long the term is going to be. So waiting is really not always your best friend. Having a conversation, asking the questions, getting your information up front so you know what you're getting into. Yes, we know that rates can change over time. But understanding the risks of waiting is really, really important. And there's a lot of people out there that are shaking SHIV's hand saying, thank you for getting me locked and loaded a year ago or 2 years ago because you saved me. Now I would have been looking at, and 2% in an interest rate can be a significant amount of your cash flow every month. So we want to make sure we're protecting that. And that's what our RBC Mortgage Specialists are for, is to help guide you through that process and make sure you're getting the right advice up front.
One more thing to add on to that. If you do lock in today and, people think that, okay, rates are high these days, we'll rather wait. It's still worth it to lock it in today, because if the rates do drop tomorrow, we will be competitive in the market and lower your rate at the time of completion. So it doesn't mean you're stuck in those rates and you'll get the higher rate that you locked in for today. If the rates are lower tomorrow at the time of your completion, we will compete and give you the better, the lower rate at that time.
Absolutely. Thank you
Awesome.
for that, Shiv. Yes, you're never going to pay more than. That's what we say, is
Right.
you're never going to pay more than this.
Exactly.
But if rates are lower, and we do anticipate, I mean, there has been talk that rates will start to come down. So depending on the length of your rate cap, how long your construction is going to take, time is probably on your side at this point, right? So we were just chatting earlier about renewing our mortgages and what we should do. And it's it is a kind of a bit of a wait and see game, but you want to have the conversation and make sure that you're protecting yourself for sure. Is there
Another
any
question.
questions? Yes, go.
Yeah. So is there a benefit to going the 5 years, or should you do it 2 years in advance or 5 years?
So the 5 years is really the time frame, or the rate cap or rate hold, whatever you want to call it, is really based on the length of the construction. So we have some projects that will complete in 6 months. We have some projects that may not complete for 5 years. So it's really dependent on the developer and what their anticipated completion dates are. Those are typically advised in the purchase and sale contract. If we're working with the developer or the sales and marketing team, and we actually have a package for the development, we would have a disclosure statement that would also outline that information. But it's very site specific, Jerome. It's not based on what you want. It's based on what the anticipated completion dates are for that specific project, wherever it is.
Right. Okay.
Yeah.
Now, within that approval or the rate hold that we do, there obviously you can pick a 1 year, 2 year, 3 or 4 year term, right? But the hold that we do for the actual project is separate than what it is for the actual rate on the mortgage.
Yes.
And if there are delays, is it flexible as well? Like delays in the construction?
Yeah, we always try to have an extended period upfront anyways. If the builder is saying, 36 months, we try to lock them in for 48 upfront. I usually try to do that. I advise my clients to just do that because we see that happen quite often. Okay. But what I, in a scenario, let's just say we've stretched it to 60 months and now it's going past that. Yes, we can. There is a calculation that we use to give, the rate does differ a little bit, but there's a sliding scale, I believe, on a monthly basis, will go up by about 10 basis points or so. Yeah.
Okay.
Yeah.
Good to know.
Yeah.
Thank you.
Yeah.
Yeah. And that firm approval, the big thing is the firm approval will stay intact. So the approval will not be in jeopardy. The rate may change, but the approval will stay intact, and we won't revisit that information. So that's another great point.
Yeah.
From a protection standpoint, we know that this is a very personal conversation to have, but it's one that we find a lot of value in, and it's really important that our buyers and our clients understand. So with your home purchase, you can obviously protect your home purchase. You can protect your mortgage and your home. So in the event that we have, let's just say it's a couple or two spouses that purchase a property, pre-sale property. So the pre-sale property isn't going to be completed for 3 years from now. And at that very initial conversation, Shiv's going to have that conversation around, what does it look like? Do you have protection elsewhere? Is this something that you would consider? Our HomeProtector coverage will provide life, disability, and or critical illness coverage from the time of application. So the great thing about our program, and there is no other financial institution out there that will do this, is we will protect you throughout the construction period. So your mortgage has not funded, we haven't advanced anything, and as a client, you are not paying premiums during construction. God forbid something happens to one of the spouses or partners in the purchase during the construction period. When it comes time to fund, we will pay off that mortgage. God forbid somebody passes away and you have not paid a cent. during that construction period. So essentially, you're applying for coverage today. You don't pay any premiums until your mortgage advances. But in the event somebody passes away, your mortgage will be paid off when it does fund in 3 years from now. So it's a really nice, again, just gives clients peace of mind. I actually just had a call with another real estate company earlier today, and they actually had that scenario where somebody 2 weeks prior to completion, her husband passed away and she had to assign it. She couldn't complete. She had to assign it and she lost money. So, added protection, peace of mind from a buying perspective. You've got your firm approval, you've got your rate locked and loaded, and now you also have coverage in the event, God forbid, something happens to yourself or your loved one. So really great added benefit there for sure as part of our program.
Yeah, so and this is just included. It's not extra like premium or extra cost on top.
There would be an extra premium once the mortgage advances, but the great thing about this is because there is no mortgage for the first 3 years of construction until we complete, you're not paying for anything, but you're protected, right?
Yeah.
So once the mortgage funds, then of course you would start paying a premium. But in the event something happened during that construction period where you weren't paying premiums, your mortgage would be covered if you were approved up front, of course.
Got it. Thanks.
Yeah, for sure. I want to pause just for a second, Jerome. Are there any questions or comments? I'm not seeing any come up on my screen, so I just want to make sure, because you said you did have some maybe prior to.
Yeah, there's no new questions.
Okay.
I guess the question that I got prior to has already been answered. Like if the rates do go down, they can go with a lower rate. They're not, yeah. But then if the rates go up, they're since they've locked on the capped rate, they don't have to go with the higher rate.
Exactly. Yeah, exactly. You bet. Okay. Let me know if any other questions come up, because I want to make sure that we answer those.
Yeah.
So obviously I touched on a lot of this already, but obviously our team, whether you're working with Shiv or any other mortgage specialist with RBC, we really try and bring the power of RBC to you. So we're going to work with you from the moment you sign that contract right up until completion and you get your keys and you walk in those doors. And on top of all that, we also try and anchor you with the closest branch. So in the event that you also bank with RBC, we're making sure that your whole relationship is looked after. So who knows, maybe when it comes time to moving in, you need drapes or you need cleaning or you need, moving service. We have all of these extra advantages to our program and to our support that can obviously lend a hand. So we want to make sure your banking's looked after. Maybe you're looking at going out and buying new furniture or what have you. We want to make sure that we're there for you, and whatever you need from a banking financial perspective, our mortgage specialists and our team are going to be there again from beginning to end, right up until the funding. I think the next slide is talking about our program. So I'm going to hand this one over to Shiv, because this is his expertise. To talk to you a little bit about the program specifically.
Awesome. Thank you, guys. So pretty much, for any new clients that are coming to RBC for financing, we definitely try to help them, in the best way possible to make sure that their financing needs are met, and these are certain programs that we do offer for individuals, that are self-employed, or if they're investors or non-residents that are new to the country and new to Canada as well. Depending on the client, I'll go through their finance, statements and so on, and their tax returns to review and make sure that, depending on how much money they have available to put against the property and, how much financing they're looking for, we can then decide which program will best fit them according to what they're looking for. The first one, self-employed, straightforward. Anybody who is a business owner or on commission sales based, employment, we can usually put them under this policy where, we're able to go stated income. So there's two portions to that. The first portion is if you're doing minimum down, which is default insured. So you can go, as low as 10% down on this policy, where we can get you qualified for, a buyer who's purchasing his primary residence. This policy is only eligible for primary residence. It can't be used for investor. Okay, so depending on the amount of cash that you have available, going through default insurance, you do end up paying fees to Genworth. It's their business Alt-A program. We usually put it under that for default insured. And if you have enough to put down towards 35%, then we can do it through RBC channel. And, then there's no additional fees and any additional cost to the client. The amortization is also reflective of that. Going default insured, you're getting a maximum of 25 years, meaning that your payments will be a little bit higher. With the 30-year amortization that you get with the conventional self-employed program through RBC would be 30 years. Secondly, for investor policy, now this is a plus point for RBC. A lot of the banks out there require 25% down for investor mortgages. With RBC, we can take it up to the maximum, which is allowed in the market, which is 20%, and you can get up to 80% loan to value on your purchase. We're also able to add the rental income on the property that is subject to be built. The appraisers that we usually have assigned to the building or the project are usually working hand in hand with the builder. Sometimes they even have projected market values based on what they are expecting to pay the buyers at the time of completion for the rent amounts, because some of these pre-sales will have a company assigned that will guarantee X amount of rent at the time of completion. So we can work with them to figure out how much rent we can use to add to the income to use in the application to qualify the client.
Okay. Question.
Sure.
Do you add the full rental income, or is it just
No,
half?
there's a certain percentage. Now,
Okay.
depending on the area you're buying in, and also the obviously the location, and we go up to 80% of the investment, right? So
Okay.
if the market rent is $1,000, we will use 80% of that as add back into the application for rental.
Okay. Okay. But then it's location dependent as well.
Yeah. So, if you're in a major city, like let's say Vancouver, we'll go up to 80%. There are, certain areas that might be a little bit less.
Got it. Yeah.
Yeah. Sounds good. And then obviously the next two policies are more so for newcomers to Canada and non-residents. Now, non-residents, anybody that doesn't reside in Canada for, anybody outside of Canada for more than 6 months is considered non-resident. We're also able to finance for anybody who lives in the U.S. Now, I know this policy might be kind of changing in the near future. In January, I believe there might be some changes to this, and where if the government doesn't allow us to finance for foreign buyers, then that policy probably will be non-existent at that point. But at this point, it still exists, and if you do have any buyers that that are looking to get their financing in place prior to that, I think they'll be grandfathered onwards to next year for those. And both of these are as stated, 20% down for anybody who's a non-resident living in the States. We can use their income, so if they're declaring X amount of their W-2 T4 slip, considered in States, or any self-employed income, we can use it for approving an application here locally. Anybody who's a non-resident outside of Canada or North America or US, we can use their tax returns from back home, verification of employment and assets to qualify. There are obviously certain guidelines around how much money they need to show. The down payment requirement is a little bit higher, closer to 35%. Plus, some of them do ask to have at least 1 year of mortgage payments plus property taxes and expenses for that house for 1 year on top of the down payment to qualify under those policies. Newcomers to Canada, same. It is broken down into a few different segments. Default insured, that would go through CMHC for anybody who doesn't have recent credit history. They're new to Canada, they within the last 5 years, if you've been in Canada or just recently arrived, then up to 5 years we can consider that under that program. Now they need to have, depending on if you're going default insured or if it's conventional with 20% down, would depend on their employment and what their plans are going forward. So depending on the client, I will go through their current situation and then let them know what they would fit under, right? If they have, if they have enough income to go default insured, minimum down 5%, we can do that. If not, then minimum 20% down if they have, employment and down payment. Otherwise, we do have a policy for 35% down if you haven't fully established an employment, fully to your capacity employment, what you were making back home. We can, make a scenario where, if the client is still going through school and educating themselves to go into a better employment opportunities with a higher income, it almost becomes a self-employed stated income style of a policy, but more so we can even do it with, regular employment clients as well. And one more thing I want to add on is with these policies, with the pre-sales, we also cover the cost of appraisals as well within that policy. I don't know if we said that earlier or not, but that usually cost is above, over and above any transaction most of the brokers or lenders would be charging. Usually costs around $300-400. RBC will cover that for any pre-sale clients. Any questions about any of these? Yeah, let me know.
Yeah, the cost of appraisals thing is pretty big.
Yeah, and depending on the site, with the project, we do have specialized programs for them. Like we'll cover certain, appraisal costs and so on. And depending on the location of the site, sometimes we can even assign a branch where they can cover, opening up a new account and give some kind of a, that's we like to anchor the client with the branch if we are signing them up for a mortgage with us and make sure that they're taken care of. Like Julie said, fully look at the full financial picture and have all the partners involved at that point.
Mm-hmm. I do have a question from some of my newcomers to Canada. Yeah. They always ask what should they be doing while they're trying to save for that 5% down to build up their credit. Do you have any tips for that?
I always recommend, this is something we do just on a day-to-day basis, even with anybody opening up an account. We always tell them to set up a, savings plan, even if you can do $25, $50 a month towards a TFSA account or an RRSP, which, they can do their first-time home buyers withdrawal from. And secondly, get a credit card, right? Start using your credit and pay it off monthly. That also helps build your credit. Depending on, obviously, if you're going to deal with RBC, that'll build your relationship with RBC. The more products you have with us, you're showing us a pattern of savings. Those type of things make you a stronger client. RBC is more supportive of that client and they understand the client more, where we can get more exceptions for those clients, right? And where let's just say they don't have enough of a history, that's where the Newcomer Canada program will come in, right? And we can show them that, hey, look, this client's been paying rent for X amount for so long versus, not having any history, right?
Perfect. Thank you.
Yeah.
Any other questions, Jerome?
Yeah. Let me just find it here. Oh yeah. So back to what we talked about before with renewing their mortgage. Any suggestions or tips as their renewal comes?
Yeah, at this point, end of the day, depending on what type of a mortgage you're in previously, a lot of the clients have gone into a variable type of a mortgage where their amortization is very excessive at this point, and at renewal is going to impact them quite a bit. So the payments will go higher. And anybody who's in a fixed rate mortgage, luckily their payments have been fixed, and only thing they need to really worry about is the new rate at the time of the renewal. Obviously the rate will impact the higher payment. We can always look at the option of like I was mentioning earlier, to transfer that whole mortgage into a HELOC or a line of credit type of a segment where you're only paying interest only while we go through these high rate environment, right? And a lot of people are kind of hedging towards is to say, okay, let's just keep it open and then lock it in when the rates do go lower. So keep it open, just pay interest only, which is lower than paying principal plus interest. Pretty much anybody in a variable mortgage today is in that situation anyways, because they're only paying interest only on their mortgage payments even, right? Because the rates have gone up so much. Yeah.
And can you talk about more of the HELOC? Like, what does one need to qualify for a HELOC on their property?
Yeah, it's all based on income and equity, right? So just like you would qualify for a mortgage, we would qualify you for a line of credit. Line of credit rates are a little bit higher than mortgage rates, but right now we're giving out prime plus 0.5%. So prime's at 5.95. So your line of credit rate's at 6.45. Versus you taking a fixed or even a variable mortgage right now, we're offering 5.75. So it's not a whole lot of difference, about a 0.75%, let's just say. So for anybody who, instead of locking it in at such a high rate, you don't want to be stuck in that term for 3 to 5 years if the rates come down in a year or two, right? So a lot of people are saying, okay, well, why not just pay the extra 0.5% or 0.75% and just do interest only, which will still be lower than what your payments would be on a 5-year fixed or a 5-year variable mortgage, and carry this mortgage for 6 months to a year until rates do start to come down and you can eventually lock it in.
Mm-hmm.
Right.
Another question: if someone does a variable mortgage right now instead of a fixed, are they able to lock in a fixed rate, like without paying any fees to cancel that variable?
Yeah. So, if let's say you took a 5-year variable today and it's at the rate of 5.75%, a year goes by and now all of a sudden the banks are offering, 4% on a 5-year fixed, So yes, you can lock it in as long as whatever's remaining on your term is being locked in. So let's say 5-year term today, a year later you decide to lock in, you can fix it in for either a 4-year fixed or a 5-year fixed. You can go into a 3-year because you have 4 years left on your term.
Mm-hmm.
Right.
Okay. And there's no fees with canceling?
No.
Okay.
No, it's not canceling. It's simply just you're transferring from a variable close to a fixed mortgage within the same bank. Mm-hmm. If you transfer to a different bank, then yes, there will be obviously penalties to break that term and go to a different lender, right? Mm-hmm. But within the same organization, you should be okay. Yeah.
Perfect. Thank you very much. I don't see any more questions. I think we're good. Yeah.
Great.
We're good.
Yeah. If there's any other questions, do let us know. I'm sure our information will be on the slide here next, and feel free to reach out anytime.
Yeah. If you want to pull up the next slide, Jerome, our contact information is there for people to jot down if they want.
Perfect.
Yeah.
Yeah, thanks so very much for joining us. I know people are going to tune in later to rewatch it. And it was very informative.
Excellent.
Awesome. Thank you, Jerome, for having us on here.
Absolutely. It's been great. Enjoy your evening, everybody.
Yeah.
Thanks, guys. Take care.
Yeah, bye-bye.
Bye.
Bye-bye.